Good morning. Welcome back to Risk Management and Insurance. We shall begin with lesson 5. We began with some of the challenges confronting businesses, some of the risk types under businesses. The case study here is Nigeria and some other sub-Saharan countries in Africa. We stopped at the political and geopolitical risk. Today we shall begin with operational resilience risk. From the word operations, having an operations department in any going concern, that is like the main body, that is like the main department for which every manufacturing concern thrives. It pertains to the ability of a business to maintain critical operations and services in the face of disruption or adverse events. It includes risks associated with dependencies on key suppliers of resources, key supplies of materials required or needed to meet up with its numerous customers. We also have technology failures, the internet provider, the software, and perhaps the hardware suppliers as well. We also have cyber incidents, the hackers, those who steal info on the web. We also have natural disasters and pandemics. Natural disasters like volcanoes, like hurricanes, tornadoes, and pandemics. We have the Ebola, we have the COVID-19, among many others. Businesses need to assess their operational vulnerabilities, implement robust resilience strategies to mitigate against such from happening, and ensure continuity plans are in place to withstand and recover from disruptions effectively. All these are embedded under what we call the operational resilience risk. Next is the market disruption risk. We are talking about types of risk confronting businesses. You have the operational resilience risk, just highlighted. And then we move on to the market disruption risk. We have the financial crime risk. Financial crime risk, the emerging technology risk, we also have the crisis management and business continuity risk. Next, we have the talent and human capital risk. We have natural resource and environmental risk. We have health and safety. We also have the dependency risk. And of course, regulatory and policy risk. All these are other types of risks confronting businesses. Shall I begin with the market disruption risk? We have explained the operational resilience risk. With that, we move on to the market disruption risk. The market disruption risk arises from the threat of new technologies. The existence, the arrival of a new technology can either make or mar a definite trend, a definite organization from moving forward or being pushed aside in business. We have the several business models that can be adopted in line with its vision and mission for competitors disrupting existing markets and industries. Disruptive innovations such as digital platforms. We have the mobile apps where organizations use, especially that of banks. The mobile app, you need not walk up to the bank to channel your complaints on your application used by banks. You can talk, you can chat, and you'll be attended to. E.g., we have the Ziva on Zenith Bank on WhatsApp. You interact with them as well as MTN. You have a WhatsApp channel, you can interact with them, and this is good enough for every going concern in the technology world. You have the artificial intelligence and the blockchain. All this can rapidly transform industries, challenging traditional business models and market dynamics. The market is dynamic because it is static. It is prone to change. Businesses must anticipate, must be able to think ahead. That there are several potential disruptions that may occur, that may crop up in the event of them growing. Therefore, there is need to monitor these industry trends and innovate to stay ahead of rivals and capitalize on emerging opportunities. Essentially, we have the R&D department in every going concern, that is the research and development. We also have the risk department. All these are geared to ensure that they go into research, look for solutions that are beneficial in order to mitigate against any form of risk that may pose danger or that may affect the overall achievement of its congruent goals and objectives. We have the financial crime risk. The financial crime risk. It encompasses risk related to money laundering, fraud, corruption, and other illicit activities that can undermine business integrity and financial stability. Related to money laundering, fraud, corruption, and other illicit or illegal activities that can affect the business integrity and financial stability. Therefore, businesses operating in high-risk sectors or jurisdictions may face increased exposure to financial crime risk, requiring robust anti-money laundering (AML), know your customer, which is KYC, and anti-corruption compliance program. Effective risk management involves implementing rigorous due diligence processes, monitoring suspicious activities, that is the inflow and outflow of perhaps huge amounts of money within the context of the industry, and cooperating with law enforcement authorities to combat or control or reduce financial crime. You have the emerging technology system. Emerging technology risk refers to the uncertainties and potential drawbacks associated with the adoption of new and untested technologies. While emerging technologies offer opportunities for innovation and efficiency gains, they also pose risks such as technological obsolescence, interoperability issues, regulatory challenges, and ethical concerns. From the word emerging technology, things that happen, the new ones that are coming up, that will flush out the archaic, the ill-timed, the old one. Businesses need to conduct through all these. They need to conduct thorough risk assessment, pilot steps, and stakeholder engagement, full stakeholder engagement, to navigate the complexity of emerging technology adoption responsibly. The crisis management and business continuity risk. Crisis management and business continuity risk relates to the ability of a business to respond effectively to crisis and maintain essential operations during emergency. The ability of a going concern, a business, an organization, a company to respond promptly, effectively to crisis and maintain essential operations during emergencies can be categorized under what we call the crisis management and the business continuity risk. Of course, crisis can include natural disasters, you have the accidents, you have the public health emergencies, cyber security incidents, and reputational crisis. Businesses must also develop comprehensive crisis management plans, establish communication protocols, and conduct regular drills to ensure a coordinated response and minimize the impact of crisis on stakeholders and operations. It is important, it is pertinent to note that it is necessary for every organization to develop a comprehensive crisis management plan, should any come into place. You establish a communication protocol and you conduct regular drills to ensure prompt response, coordinated response, in order to arrive at minimal impact of crisis on stakeholders as well as its modus operandi. Next is the talent and human capital risk. The talent and human capital risk encompasses risks associated with workforce management, including talent shortages, disacute, skills gaps, employee turnover, and workplace safety issues. A lack of skilled employees or succession planning can hinder business performance and innovation, while employee dissatisfaction or labor disputes can disrupt operations and damage morale. A going concern without the required skills, the required knowledge, know-how, the definite employee or its employee is aiming towards disruption. There is need for training and development for every employee in all spheres of life. This is essential in order to arrive at the best positioning of a going concern. Why? Because the dissatisfaction of an employee or labor dispute can disrupt operations and can as well damage user morale. Therefore, businesses must invest in recruiting, in training, and retaining top talent, those that are best fit to occupy a definite position or play a key role. Promote diversity and inclusion, sense of belonging, and as well as create a positive workplace. A positive workplace culture to mitigate human capital risk effectively. You have the natural resource and environmental risk. Natural resource and environmental risk involve risk associated with resource scarcity, environmental degradation, and climate change impact. Businesses reliant on natural resources or vulnerable to environmental regulations may face supply chain disruption. If a going concern solely relies on natural resources or is vulnerable to environmental regulations, such may face supply chain disruption, increased costs, and reputational damage due to unsustainable practices or environmental accidents. This will surely happen should a definite organization, company, firm, industry solely depend on natural resources or is vulnerable to its environmental regulations. As such, he or she will face supply chain disruption, increased costs, because they already know you can't go without them. You will be available to ask them for these materials, the resources needed for operation, for production. To also cause the reputational damage. Why? Because of their inability to meet up with customers' requests, as well as the turnaround time, due to unsustainable practices or environmental accidents. Sustainable resource management, energy efficiency measures, and environmental stewardship. All these initiatives can help businesses curtail their environmental footprint and mitigate against any associated risk. We have the health and safety risk. The health and safety risk pertains to risk or risk associated with workplace accidents. That which happens within the confines of the organization. You have the occupational hazards, especially that in the manufacturing world, the production line, and health-related incidents that can harm employees and affect business operations. Failure to comply with health and safety regulations can result in legal liability, fines, and reputational damage. Should any going concern or organization fail to comply with health and safety rules, the health and safety regulations, fines, legal liabilities, and reputational damage will definitely be sustained. Bound to face all these, that is, the legal liabilities, fines, and reputational damage. Essentially, businesses must prioritize employee health and safety, implement robust safety protocols, provide adequate training and protective equipment, and conduct regular audits and inspections to mitigate health and safety risks effectively. All this has been done, that is prioritizing health and safety measures, implement robust safety protocols in order to avert or prevent such from happening. And should it happen, there will be a minimal case. Provide adequate training programs and protective equipment. We also conduct regular audits from time to time, inspections to mitigate health and safety risks effectively. We have the dependency risk. It may arise from over-reliance on key customers. We so much depend on a definite group of clients, customers. They may fail eventually. Same is applicable to suppliers or partners. They cannot possibly blame themselves. They may have a better offer elsewhere. I will boost. I will serve as a boost to them. The rational consumer will tend to operate in an environment that is filled with reduced costs and increased profit. The suppliers, the customers, or partners may wish to replicate sales, exposing businesses to potential disruptions if these dependencies are compromised. For example, a business that is heavily dependent on a single customer may face financial instability if the customer decides to terminate such a relationship. And a business will now face what is called old guard. Similarly, supply chain disruptions or the failure of critical suppliers can disrupt production and distribution channels. The failure of some important suppliers can disrupt production and affect production, can reduce production and distribution channels. In other words, businesses must identify alternative sources of supply. It shouldn't depend on one. You should have at least 3 or more supply channels, as well as distribution channels, to mitigate dependency risk effectively. Simple and straightforward. Regulatory and policy risk. Regulatory and policy risk stems from changes in government regulations, policies, and geopolitical dynamics that can impact business operations, market access, as well as international trade. The incessant government policies, laws, regulations, and geopolitical dynamics emanating from the government can impact business operations, market access, and international trade. Therefore, businesses operating in regulated industries or global markets must monitor regulatory development. And that's why we have the R&D department in every going concern. You assess compliance to requirements. That's why we have the internal control and you have the audit department. We anticipate potential policy changes that may affect its modus operandi. We anticipate think of potential policy changes by the government which may affect their operations. Political instability, for example, we also have the trade disputes and sanctions regimes can also introduce uncertainty and geopolitical risk, requiring businesses to adapt their strategies and mitigate potential impact on their operations and investments. Again, political instability, trade disputes, and sanctions regimes can also introduce uncertainty and geopolitical risk, requiring businesses to adapt their strategies and mitigate potential impact on their operations and investments. These additional types of risk highlight the diverse and evolving challenges that businesses may face in today's dynamic and interconnected environment. Effectively managing these risks requires a comprehensive understanding of their nature, impact, and interrelationships, as well as proactive measures to identify, to assess, mitigate, and monitor risks to safeguard business resilience and sustainability. And then we move on to external risks of a business. There are those factors outside the control of a going concern that can impact its operations, performance, and strategic objectives. There are the factors affecting a going concern, every business. Why? Because they are outside the control. They are not within the confines of the territory. They are outside. They are beyond organizational control. Of course, They can emanate from the broader economic, political, social, technological, and environmental context in which businesses operate. And with that, we'll talk about some of the common external risks that every business may face. External risks that businesses may face. You have the economic risk, you have the market risk, regulatory and legal risk, political and geopolitical, risk, social and cultural, you have the technological risk, you have the environmental risk, supply chain risk, health and pandemic risk, natural resource risk, among others. All these are the external risks that businesses may face. Shall I explain them one after the other? Some common external risks businesses may face. Economic risk, market. Let's quickly highlight them. There's regulatory and legal, political and geopolitical, you have the social and cultural, technological, environmental, and supply chain, health and pandemic, natural resources. Some common external risks businesses may face. We shall begin with the economic risks. Economic risks are those types of risks arising from fluctuations in macroeconomic conditions macroeconomic situations and concerns, such as the gross domestic product growth, the GDP, we have the inflation and deflation, the interest rate, and currency exchange rate. Economic downturns can lead to reduced consumer spending, declining demand for goods and services, and tightened credit conditions, impacting businesses' revenue and profitability. Why? Because interest rates will shoot up. There will be an astronomical increase in interest rates, especially that from the loan companies or financial institutions like banks. Conversely, rapid economic growth may create inflationary pressure, supply chain disruptions because of rising or increase in costs, and overheated markets, posing risk of overheating and asset bubbles. The high interest rates and currency exchange rate or fluctuations like the dollar, the euro, and the pound sterling will shut off sporadically. There will be an astronomical increase. Therefore, economic downturn, as regards it, can lead to reduced consumer spending, declining demand for goods and services. People who do buy in bulk, like cartons of Indomie, for instance, do not tend to buy like half, if not less than. They not buy in bits, because you have more money choosing fewer goods. Inflation has set in. We also have the deflation. There are also what we call tightened credit conditions. There are some credits that may not be released either to individuals, groups, or entities. This will definitely impact businesses' revenue and profitability. In terms of production, we need this money up front to get materials, to get resources for production. And since there is heightened or tightened credit conditions, we will also think otherwise. Production will decrease. It will also affect the revenue of such an organization. Conversely, rapid economic growth may create inflationary pressures on everyone, not just the going concern. As such, supply chain disruptions as well will crop up, and overheated markets, posing risk of overheating and asset bubble. You have the market risk. The market risk relates to changes in market dynamics, including shifts in consumer preferences, competitive forces, and industry trends. Changes in market dynamics, the environment, including shift in consumer preferences, they decide to shift from Milo and Bournvita to Ovaltine, rival forces, and industry trends. Mobile phones, for example, may wish to switch from Android to iOS. Changes in market demand, technological innovation, or disruptive business models can disrupt traditional industries and create new market opportunities. Therefore, businesses must anticipate market shifts, monitor competitor activities from time to time in terms of adverts, reduction in prices, or promotion, and adapt their strategies to remain competitive, to remain dominant in the market, and as well as capitalize on emerging trends. You study the shift, you study the market. Whenever they wish to go on any promo or advert that may affect you in one way or the other, maybe infinitesimal, maybe negligible. Even at that, you need to monitor your competitors, monitor the activities, anticipate market shifts from time to time, e.g., the telecom sector. There's no one that has a definite thinker without the other. Why? Because network fluctuations, maybe tariffs, as well as some of the value-added potential, the freebies they get from this at the expense of the other. And adapt such a strategy to remain competitive, to remain dominant, and capitalize on emerging trends. Now the regulatory and legal risks. The regulatory and legal risks arise from changes in law, regulations, and government policies that affect business operations, compliance requirements, and market access. Regulatory uncertainty, compliance burdens, and legal liabilities can as well create operational challenges and increase business costs. It will definitely increase business costs because of regulatory uncertainty. Once a definite government is out, the next one comes in, bring its own modalities, bring its own modus operandi, bring its own policies. There are legal implications. They constitute what we call legal liability. They serve as a burden in terms of compliance and the regulatory uncertainty as well. Increase what we call business costs. In order to even forestall all this, businesses must stay abreast of regulatory development, engage with policymakers and industry stakeholders, and implement robust compliance programs to mitigate regulatory and legal risks effectively. Political and geopolitical risks. Political and geopolitical risks stem from instability, geopolitical tensions, and government actions, decisions that can impact business operations, investment, and international trade. There are factors under this category, such as changes in government policies, trade disputes, sanctions regime, and geopolitical conflicts, which of course can introduce uncertainty and volatility in global markets. Therefore, businesses operating in multiple territories, locations, jurisdictions must assess geopolitical risks, diversify operations, and implement contingency plans to mitigate the impact of political instability and geopolitical events on the operations and supply chains. It is necessary for every organization operating within the confines of these jurisdictions, or operating in multiple jurisdictions, to assess the geopolitical risks from time to time, diversify operations, and implement contingency plans to mitigate the impact of political instability arising from the government's part, as well as geopolitical events on their operations and supply chain. On this note, we have come to the end of lesson 5. When next we meet, we shall continue with other external risks that businesses may face. Thank you all for listening. See you next time.